Yes, the asymmetric portfolio is up 51% over the past year, nearly doubling the performance of the S&P 500. And there's not anything complicated I'm doing in the asymmetric portfolio. There are simple rules around the kind of companies that I'm investing in and how I'm investing. I'm not day trading. I buy stocks one time per month and I rarely sell. So today I want to go through exactly what's going on in that portfolio this year, what the foundational principles behind the asymmetric portfolio are, and how a few simple strategies are playing out with very, very big returns. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And if you haven't checked out Asymmetric Investing, my newsletter, you can get a link to that below. There's a link on the screen as well. And that's where I'm going to go through a little bit today is the frameworks of asymmetric investing and how that's led to these market crushing returns. So I'm going to get to that in just a second. Heads up folks, interest rates are falling, but you can still lock in a 6% or higher yield with a bond account from public.com. Now this is a pretty big deal because when interest rates drop, so can the interest you earn on your investments. But a bond account allows you to lock in a 6% or higher yield with a diversified portfolio of high yield and investment grade corporate bonds. You can see what that looks like on the screen. So while other people are watching their returns shrink, you can sit back with regular interest payments, but you might want to act fast because the yield is not locked in until you invest. The good news is it only takes a couple of minutes to get started at public.com. Lock in that 6% or higher yield with a bond account only at public.com/ASYM. Now I want to start with the frameworks of asymmetric investing because the idea here is to find stocks that have huge return potential. The baseline is any stock that I buy, I think can 10x in value over the next 10 years. Not all of them will, but if I hit just a few winners, that will overcome any losers that are in the portfolio. But how do you find these kinds of stocks? You have to have the right mindset. So you need to think in decades. And I'm going to put a link to this frameworks article. This is one of the main pieces on asymmetric investing. This is free to access, but you need to think long term. The shorter your time horizon, the less likelihood you are going to make money. If you have a 20-year time horizon, historically speaking, you have a 100% chance of making money in the market overall. And staying invested is a key to that. If you miss just a few of the biggest days of any given year, your returns are going to go negative. This sounds crazy, but you want to stay invested even in frothy environments like we're in today. You also want to take more risk. This gets to why venture capitalists can make so much money, why private equity can have higher returns, and why things like treasuries and municipals generally have lower returns. The further you are out on the risk curve, the more your return potential. And if you're taking that risk, the companies that win, you need to let them compound. A company can't 10x in value unless it doubles, triples, and quadruples first. You got to let these things work for decades sometimes. The best investments in the world, Netflix, Amazon, Tesla, they're all wildly volatile short term, but long term, they've been massive winners for investors. We have to embrace uncertainty. The best time to buy a stock is when the market doesn't know exactly what's going to happen in the next quarter or in the next year. And then this is the key. This is what has worked in 2024. Buy great companies with lots of upside potential and do absolutely nothing. Just don't sell them. So with that in mind, I want to show you how this portfolio works. I invest $500 every single month and I fully invest that money into the portfolio. And the idea here is that I'm going to do the research and I'll show you where the conviction is in the companies that I'm covering. So higher conviction, I'm going to invest more money. Lower conviction, maybe a bit of a binary outcome. I may invest a little bit less money, but I'm going to invest that money every single month. This is what I'm talking about with a simple strategy. That 51% return that I talked about, that is buying stocks on the first trading day of the month, and that's it. I rarely sell stocks. November was actually an outlier. I sold 2 stocks, but normally I am just accumulating more stocks, and that's where the most of this return is going to come from. So I can pick from any of the stocks in the asymmetric universe, and any sales or dividends are reinvested in the stocks in that universe. That's the simple rules behind the asymmetric portfolio. But how do I find the companies that have been winning, the stocks that are up 400% or more? That gets to a lot of the strategies that I talk about here on YouTube a lot, and then I cover in more depth in asymmetric investing. I want to go through a couple of those and just give examples of the things that are working right now in the portfolio. I can't cover everything about asymmetric investing in this video, but I'm going to give you 4 things that hopefully you will take something away. And I want to start with a strategy that I lean into a lot with asymmetric investing. That's the smiling curve. On the internet, what often happens is there's a small number of winners, usually 1 or 2 winners in a market, and those are the companies that can scale. Other competitors just don't have as much scaling power. That means they don't get as many subscribers, and ultimately they can't charge as much for their services or generate as much value. We see this in streaming. We see this in social media, where Facebook not only has more subscribers than Snap and Reddit and all of its other social media competitors, it also generates more revenue per subscriber. So those things multiply to make Facebook a much more profitable company than any of those competitors. Once you have more profits, you have more money to play with. You can invest in new things. You can invest in the metaverse. You can invest in these AR glasses. It's a flywheel once you hit the top right corner of the smiling curve. The other side is more niche products. So one example of that would be in media, YouTube is going to have more niche suppliers. I am one of those producers. I am one person with a very low cost structure, putting out content on a platform that has billions of users. So I don't need to have the infrastructure of CNBC or of Bloomberg. I can be a very niche supplier in the market and reach customers that value my content. This is the 2 ends of the smiling curve, and it plays out over and over and over again on the internet with all kinds of different markets. A couple that have worked really well over the past couple of years. One is Spotify. Spotify is the largest company in streaming music, but it's really started to show that power over the past 2 years in particular. And that's as it's gained market share from companies like Apple, YouTube, Amazon. It is really the biggest winner in streaming music. And that means not only does it have more subscribers, Spotify actually charges more for a subscription, for a premium subscription than those other services. It does that currently with bundling. It adds in audiobooks to those bundles. That's increasing the company's margins. They've gotten their costs under control. They're getting operating leverage in the business. And that's why their free cash flow is exploding. What comes next for a company like Spotify? They build on that success. They move into video. They build out their advertising network. Again, the flywheel is now going for Spotify, so success will breed more success for the company. Another great example is Zillow. In the housing market, how are you going to find a home? You're either going to look for a niche realtor in your area, or you're going to go to Zillow, the company that has access to listings all over the country. There are basically 2 players in that market. There's Zillow and then there's CoStar. Zillow, I think, is clearly the leader, not only in searching for homes, but they're now growing tremendously quickly in the rentals business. So this market isn't fully formed yet and probably won't be for the next decade or so. But right now, Zillow stock is rising on the idea that the company is winning as the aggregator in the home business. So they're going to be the place that you're going to go to look for a rental, to find a new home, to find a mortgage, maybe to find insurance or movers. All of those things will be found on Zillow. That point of discovery is often a sign that a company is winning in the smiling curve. The final one to think about, this is one that hasn't had asymmetric returns yet, but I think will in the future, is in streaming, but it's not Netflix. Netflix is a clear winner in streaming. The second place company is Disney. And Disney has the second most subscribers when you look at Disney Plus and Hulu, but what gets added in 2025? ESPN. Sports is coming to streaming with ESPN. That is going to give Disney a very, very powerful position to not only increase their number of subscribers, but remember I talked about the other point, they're charging more per subscriber than their competitors can. When you have the NFL, college football, NBA, the Masters, all kinds of different sports inside the NBA, when you have all of this on one streaming service, that's going to be a product they're going to be able to charge $20, $30, maybe $40 per month for, and bundle with all their other services. They could have 100, 200 million subscribers and charge significantly more than Netflix charges for their streaming subscriptions just because of the value of that content. So that's that flywheel getting into effect. And I think Disney is going to be one of the asymmetric returns over the next decade because of ESPN. Now, we can't just buy companies with huge potential and hope that everything works out. We also have to pay the right price for them. And one company that is working out extremely well is Coinbase. But I was not buying Coinbase at $300 per share. I was buying Coinbase when it was $60 a share. The Spotlight article, which I'll put a link to in the show notes, this goes back to June 1st, 2023. The company's market cap was $14.6 billion, and they had $5.3 billion in cash and equivalents on the balance sheet. So more than a third of their market cap was held in cash. They had been cutting costs. Yes, we were in this crypto winter, business was down. But if the upside potential is this is a kind of company that can disrupt the financial system like we're seeing today, the potential was 10x, 100x from where it was trading in June 2023. So this is another one of those stocks. Phenomenal returns over the past year. I have done basically nothing with my shares of Coinbase because they're just appreciating. They're going up in value without me doing anything. One that I think is going to do the same thing in the future is MGM Resorts. MGM owns about half of the Las Vegas Strip, but it also has 2 casinos in Macau and is building a casino in Japan that could be one of the most profitable resorts in the world. That's not going to be open until 2030, but right now you're getting the company for an extremely cheap price. Depending on how you value it, their enterprise value to EBITDA is only about 4 or 5 times. They're also buying back between 10 and 15% of their shares outstanding each year. So that share count continues to come down. Remember, this is a market where there's not new competition coming into the market. They're not adding land to the Las Vegas Strip. Macau is limited in the number of casinos that can be built. That's a limitation by the government. Japan is not building 15 casinos. They're building a couple. That's it. So this should be a very, very profitable business a long time into the future. And if you're paying the right price, that asymmetric potential is there. And in the meantime, I'm happy to have management just buy back shares. But the third thing to look at is the optionality in the business. You're paying for something today, but what could that business be in the future? If you bought Netflix when it went public, you were buying a DVD delivery company. You weren't buying a streaming company, but it could become a streaming company. Reed Hastings has interviews going back decades that talk about the vision that ultimately played out at Netflix. He laid these things out a long time ago. So one company that I'm getting for a value and I get phenomenal optionality is General Motors. Did you know that General Motors stock is up 95% in the past year? That's not something that gets a lot of attention in the media, but this has outperformed Tesla, and it has by a wide margin. And who is leading in autonomous driving? This is where the optionality comes in. There is only one company that has put more fully autonomous miles on the road than General Motors owned Cruise. That is Alphabet owned Waymo. So those 2 companies are the leaders in autonomous driving today. Cruise is going to be back on the road in 2025 with a custom-made vehicle, a custom-made Chevy Bolt. Could mean that those vehicles are going to be lower cost than any of their fully autonomous competitors. They have the ability to scale the business because GM is the manufacturer, and they have the distribution partnerships. They're testing out a partnership with Uber, where Uber customers are going to be able to call a Cruise vehicle. But again, you're not paying for Cruise if you're buying shares of General Motors. You're paying for the company that makes most of its money on trucks and SUVs. And shares, even today, even after that 95% increase, are only trading for 6 times earnings. That is phenomenal value with optionality. If you can find a portfolio of stocks with those 2 things, it will do phenomenally well as an investor. And the fourth thing is simply letting your winners ride. Price matters when you're buying a stock. But when stocks start going up and multiples start expanding, we don't know where that's going to end as investors. And so I always default to saying I'm not going to sell a stock. Ask any investor, and the most painful experiences they have is owning the companies that were massive winners over 10, 20, 30 years, but selling them too early, selling them for 100% gain when the big gains were 10x, 100x. I have done that. I own shares of Chipotle in the 2000s. I bought and sold Apple during the financial crisis. I own shares of Microsoft before they started investing heavily in Microsoft Azure when shares were trading for 10 times earnings. If I would have simply held onto those stocks and done absolutely nothing, I would have had phenomenal returns from every single one of them. And that's exactly what I'm doing in the asymmetric portfolio. Like I said, I'm only buying 1 time a month. I'm only buying a couple of stocks every month, and I'm over indexing on never selling them. That's one of the biggest reasons the portfolio is up so much this year, is because I'm not messing with it. I'm letting those returns build. Now, if something changes about the company, if the thesis is broken, I'm happy to sell stocks, but I'm not selling any of my winners anytime soon. So if any of this resonated with you, check out Asymmetric Investing. Like I said, there's a link below and a link in the show notes. I'll put the frameworks there, and I'll also put a link to the Asymmetric Portfolio. I send an email to premium subscribers every month before I make any transactions. So all of these things were disclosed to subscribers before I did any purchases or did any selling. And like I said, almost all purchases over the past year, and I'm staying fully invested. That's a huge reason the portfolio is up as much as it is. But let me know if you have any thoughts or comments in the comments section below. Don't forget to subscribe here on YouTube. Thanks for watching, everybody, and I'll see you here next time.